Let's bring in Mahesh Patil. He is the CIO at Birla Sun Life Mutual Fund, joining into the studios. Mahesh, thanks very much for joining in. According to you, these last 2 months as we started off for the new year, were they on expected lines? Because everyone was of the anticipation that, you know, there will be a big run-up ahead of elections, but that seems to have doused out.
Well, I think by and large, I think it's in line with expectations. I think the market has been pretty range-bound. There were expectations, that you could see some kind of a rally pre-elections, but I think the global cues started to worsen around 2 months back, and we've seen the kind of a global risk-off trade. In fact, this is the 15th week in a row where we've seen money moving out of emerging market funds. And I think against that backdrop, I think we have done reasonably well. I think even our currency has been pretty stable at around 62 levels, where we have seen some pressure on emerging market currencies again recently in the last 1 or 2 months. So I think overall, I think markets has been range bound. I think it's moving in a pretty narrow range, and despite some global concerns, what we have seen emanating in the last 1.5 months. I think as we move forward, if you look at the quarterly numbers which have come in, again those have been pretty much broadly in line with expectations. No major, I think, negative surprises over there. And as we move forward, I think clearly the big event elections and at the run up to that, I think you might see some kind of an upward movement expectations start to build up now, because I think the pressure from the global markets is kind of easing off at this point in time. Okay.
Do you see any major upgrades or downgrades in terms of the earnings performance?
I think overall, if you look at it broader, this thing, as I said, compared to what we saw in the September quarter, where there was significant upgrades to the broad consensus earnings, I think after the December quarter, we haven't seen any significant change to the earnings for either FY14 or FY15. Yeah, specific sectors, okay, there have been upgrades and downgrades, but by and large, I think the broader consensus earnings next year for the FY15 is showing a growth of around 15 to 16%, which is much higher than what we have seen as a growth in the last 2 years for the broader market.
What did you make out of the CER's the tariff order that was put out yesterday, specific to Tata Power and Adani Power and even NTPC?
Yeah, so I think on the one hand, I think it was a great relief for some of these private power companies which were reeling under pressure, huge losses because the tariff was well below their cost of production. So I think in that sense, it's given some relief over there because at least they'll be able to make enough returns to be able to service the debt, so which is also good from the banking system perspective. But I think on the other hand, I think on the NTPC again, while the CRC recommendations were known, I think whether they would be implemented in total was not expected. And as a result, we saw a sharp reaction over there, which is actually not such a good, because normally these stocks are known to be much more safe and predictable. So this kind of volatility in a stock like NTPC, which is supposed to be a defensive, is not such a good thing from an investor perspective.
Okay. Talking about banks in specific, now that we've seen how most of these PSU banks have reported earnings, are there any brighter prospects for the next quarter? I'm targeting my question specific to SBI.
Well, I think if you look at the quarterly numbers, it doesn't look like the pressure on the overall stress assets is kind of abating. It still remains. I think it will take at least a couple of quarters, okay, at least that's what we understand, before you can see some easing of pressure on the overall stress assets. So I think that's something which clearly is a challenge which is being faced by the banking sector as a whole, but more importantly in the PSU banking space. And the key issue here is kind of capital which has to be put in some of these banks to recapitalize them to be able to really take care of some of the hits because of the NPA and also because of the to meet the Basel III norms in the next 3 years. So I think that's the bigger challenge which the sector faces. It's estimated almost like $40 to $50 billion of money is required to be pumped to recapitalize the banks over the next 3 to 4 years. And that's going to be a big challenge, especially in the current environment where fundraising is a problem.
What's your advice to investors wanting to build on their portfolio onto existing stocks? Is this the right time?
Yeah, I think our view has been that despite the current concerns which are there, when we are some green shoots. Okay, we feel that we are at the bottom of the economic cycle and we should see a slow recovery from here. So with that underlying assumption and the fact that we've seen current account deficit also now at a comfortable level, so rupee volatility has subsided and interest rates are at kind of a peak level with inflation trending down. So if you take a medium to long term view, which we would expect investors to take, then I think the risk reward for investing into equity in general looks pretty attractive over the next 2 to 3 years. And as I said, we are entering into a new cycle, a new government in place. So that should help rekindle even the investment cycle, which has taken a beating in the last 2 years. So I think looking at all these factors, clearly I think it's a good time for investors to start increasing the equity exposure, which has come down significantly in the last 4 to 5 years.
Okay. Post-elections, do you see a meaningful move in infrastructure as a space?
Yeah, I think this is an area which, if the government really wants to stimulate the economy revival, I think the normal traditional sectors which attracted huge capital expenditure, investments like power and metals, there is excess capacity which is there. So I don't think you will see any big investments coming in those sectors, at least in the next 1 or 2 years. So clearly infrastructure sector is one area I think where the government, any new government which comes into place, will have to focus on if they're really serious about reviving the whole investment climate. And there again I think there is good amount of investments, okay, which are going to happen in the railways, the dedicated freight corridors. I think the new bidding for the next phase of allotment will start in the next few months, but that's where we have seen sustained investments going through. But I think again the broader infrastructure, whether it is roads and this thing, I think that's an area which I think the new government would have to really focus if they want to really kickstart the whole investment climate.
Okay. From the mid-cap space right now, is there more promise versus large caps?
Well, if you look at purely from a valuation differential, I think that differential, which was pretty attractive, say around 6 months back, that has narrowed down, and especially in the quality mid-cap names where the valuations are not that attractive. But I think by and large, I think from here on, if we are looking at a recovery and as interest rates cool down, I think there is still enough upside in some of specific mid-caps. If you take a 2 to 3 year view, I think there is a good chance that mid-caps and smaller mid-cap stocks can outperform the broader market. But again, it could be very, very stock specific. I don't think some of the mid-cap stocks which are cheap and where the balance sheet is a issue, I think those stocks will take some time to really come, because we are not seeing interest rates really coming down significantly in the next few quarters.
Okay. Got that. Any specific stocks or sectors which you find a lot of promise in?
Well, stocks I wouldn't like to comment upon, but I think sectors where based on the premise that we would see some recovery in the broader economy going forward, I think we are getting slightly inclined positive towards some of these industrial and capital goods stocks which have underperformed in the last 2 to 3 years. But there again, I think some of the leading names and companies where the balance sheets is pretty strong. So any kind of revival in the economy, I think they should be the first one to benefit. And even in the banking space, though the banking sector has underperformed in the last 1 year and more recently after the increase in interest rates, we believe that some of the private sector banks now offer a good entry point with the next 2 to 3 year view, because that's a sector which we see clearly leads any kind of recovery in the broader economy, and a sector which does well in the initial phase of the economic recovery.
Okay, got that. Mahesh, thanks very much for joining us. Appreciate you taking out the time. Mahesh Patil there with his views on the markets. We are going to take a very short break on that note. We'll be right back in a few minutes.